Hello, we'll give it a few moments for people to join. Perhaps in the meantime, moving forward to our schedule for today. Yeah, so I will kick it off now. Welcome to our Americas webinar. We're looking at the global oil and gas market from the perspective of supply and demand adjustments in a constrained world. The oil and gas market is at a level of volatility that I've never seen in my 20-year industry span, and I think it's probably completely new from a global perspective. So the environment is pretty challenging. We will guide you through some of the perceptions and insights we are getting via our analytical tools. It will be 5 presenters today. So Pamela, our senior analyst, is joining us. Rohit, another senior guy, our new US analyst, Joanna, our specialist on LPG, natural gas liquids, and Johannes, our senior freight analyst. So yeah, and we have about 20 slides. You can ask questions via the Q&A functionality, and we will try our best to answer them within or after the presentation. And I also just wanted to point out that you will get an email with the slides, and I understand also with a link to the recordings afterwards. And if you like this type of presentation, get on board, become our client if you not already are. We have weekly briefings like the following presentation, just a little bit shorter every Tuesday in 2 different time zones. Now, finally, let's really kick it off. So the latest development we are noting basically in our data is that exports pretty much across the board, but specifically in the main flows of relevance, so crude, diesel, and gasoline are picking up significantly. In the case of the United States, this is just the following, the continuance of a development that has already been there for quite a long time on the refined product side, as seen down here. Also on the crude side, we're seeing more crude coming out of the US. Rohit will talk in a moment about a little bit the background why this is possible. On a global level, we see also significant increases. So there has been a very strong start to the month for Saudi and UAE crude exports with a huge step higher. That has to be taken with a little bit of caution. Usually these exports are front-loaded. There may also be some revisions to the downside over time, but it's clear that they are supplying currently more to the market. We see also not only in the US, but also in the rest of the world. In the US, the diesel export growth is particularly pronounced over the last couple of months, basically a doubling of outflows over the last 6 months or so. We see a similar increase across the globe, many countries and regions contributing to that, and we will shed more light to that also throughout the presentation. But also for gasoline, we see a clear pickup in liftings so far in July. There, it's particularly Asia and European countries who are behind this development. Now, let's move on. And Rohit, please tell us a little bit what's going on in the US crude market.
Yeah. So as David suggested in his earlier slide, US exports of crude are no doubt, they are reaching record highs. The key reason for this is Europe, as they look for more, sweet barrels, and US light sweet crude is heading that way. But on the other hand, US refiners, they have been importing more medium sour crudes and heavy sour crudes as usual. Especially this year so far in July, it's the highest since, September of last year. What we see over here is more increase on the left-hand side chart, obviously, more increase in crudes coming from LATAM as well as Middle East. Middle East grades here, especially because after the ban on Russian barrels in the US, what the US refiners have been looking to do is, look for crudes which have a higher VGO yield, can run their FCC units, So for this reason, crudes from Saudi and Iraq, they have been, a key part of the refinery diet over here in the US, especially since the ban kicked in April. Now, on the European side of things, when you look at arrivals in Europe, this chart is basically an increment in arrivals on the 2021 average. So what we are seeing over here is since the first 2 months in Jan and Feb, the European refiners have actually cut down on buying the Russian crude, the yellow part in all these charts. So Russian arrivals have been going down, and they are going significantly down. And on the other hand, they have looked at other avenues. Like I told, they are for sweeter grades. So you see increase in North American crude, South American crude, especially from Brazil and Guyana, heading to Europe. Now I'll pass on to Yanis briefly, and then we'll be back with you guys.
Thank you, Rohit. So yes, continuing where you left off, but going into the tanker market, but with this focus on the Western Hemisphere. First of all, we should note, as Rohit and David said earlier, that Part 3 crude oil exports towards Europe remain at really high levels, historically speaking. And that supports crude tanker demand. Though there's an interesting trend that it is observed when it comes to the vessel classes that are actually carrying this US crude over the past 2-3 months. And we can see when looking at ton miles that mainly VLCCs, as you can see from the yellow bar chart, but also Aframaxes have taken up employment at the expense of Suezmax tankers. To put that into perspective, Suezmax share for the US Gulf to Europe route has been slashed currently to a 12% on the market share from around 30% that was recorded in May. Now, the reason for this decline in Suezmax utilization has to do with the rationale behind the economies of scale that VLCCs provide, and also the fact that VLCCs were not finding the similar levels of employment from the Middle East Gulf that they used to find historically. But it also has to do with the fact that Suezmax availability in Part 3 has declined. And as you can see on the right-hand chart from the blue line, Suezmax utilization has increased in other regions, mainly led from the Persian Gulf, West Africa, but also the East Med, and this unsurprisingly has culminated in an almost 50% increase on the trademark Suezmax rates for the Middle East to Mediterranean route, which is the TD23 route. Now, looking forward, we're expecting that there is this upside potential for tanker demand remains out of the US Gulf, mainly for the US Gulf to Europe flows, which are poised to continue at high levels, especially as SPR releases continue and as relationships with Europe and Russia are deteriorating. And this will provide partial support for Aframaxes and VLCCs. However, the prospective return of Libyan flows, on the other hand, could pose a downside risk at the expense for these US Gulf to Europe flows. That's from me for now. Back to you, Rohit.
Yeah. So coming back to basically European appetite for sweet barrels. Before that, I would like to talk real brief of what's happening on the LATAM side of things. So yes, LATAM exports, they have continued to increase, but there has been a swing. As you can see on the left hand side, right, LATAM exports actually to Asia, they have been declining, with June being the lowest, but for July we observe rebound or resurgence of flows going to Asia, still not as high. As you can see on the right hand side on Europe, the exports to Europe, they are at like record highs, especially Spain and Netherlands buying up a lot of those medium sweet barrels from Brazil, Guyana, and also we have Mexican barrels over here. The Spanish refiners are actually running pretty hard, trying to capitalize on the margins over there in Europe. And yeah, that's about it. It's like the fundamental shift in flows from LATAM, like from Asia now moving more and more crude to Europe. Russia is the main reason for this. Like the Europeans, they're looking for all the other alternatives for Russian barrels and these LATAM crudes. I would also like to point out, like we don't have this in the chart, but also the imports of West African grades have been increasing in Europe. So That's something. Now, the next chart, we talk a little bit more about what's happening on the Russia side of things, the Russian flows. Yeah. So what we've been seeing over here is after, significant increase in Russian flows, Russian oil flows in May, in June, we now see them declining. But as you can see in the left-hand chart, there has been a shift, east of Suez. You have the Chinese and Indian buyers, especially, taking up all those discounted barrels. Russian exports, via Europe, they have never been down completely, but they have only been delayed. But there has been a shift from, exports of products to crude oil. And another key development that we have been observing, based on our ship tracking and all the stuff that we have. So it's the dark STS movements that we have been observing. So these are ships, something similar to what's been happening with, Venezuelan and Iranian crude. So we have these ships coming near, Azores or near the coast of Portugal in North Atlantic. And then what has been happening, they switch off the AIS signals and then do STS transfers. One example over here, we have this VLCC Progress V, which is heading, to Asia. It did 2 STS transfers with, Aframax vessels which switched off their AIS signals. So Azores, or Atlantic coast of Europe, North Africa, it is becoming another key region for STS transfers for Russian crude. We'll talk more about what's happening on the freight side, like more vessels which were earlier carrying Iranian crude, they are now carrying Russian crude. We'll talk more about that in the next slide.
If you allow me just to add a comment here on the left-hand chart, I do think it's worth to point out basically to see how strong Russian oil supplies to the market have stayed. So these are the exports from the Arctic, the Baltic, and the Black Sea seaborne exports. If you look at the red line, this is the total oil exports, so crude plus products. And basically, last year into this year, there has been a little bit of delay when the war started, but the overall levels, they are as high as they've ever been, or even higher. And evidently, there has been this huge shift to crude. So much less product is exported, but more crude. But this high level of exports also point to the likelihood. I mean, first of all, that Russian crude production is pretty unlikely to be significantly down from the pre-war level. And secondly, it's actually likely that domestic oil consumption is declining, and therefore more oil is available for exports. So overall, I think there may be quite a lot of people in the market that think we have lost quite some oil from Russia, but we have not. Yeah, in fact, it's rather, if anything, more than less, especially on the crude side.
Yeah.
Okay. Here we go.
Yeah. Now coming to Iran. So Iranian crude and condensate exports, basically during the sanctions, they have been struggling. But a surprising fact is, like, in January this year, the exports were especially higher. I think the highest they have ever been since the sanctions. They crossed like 1.1 million barrels a day. So that is something. But after a spike or jump in January, they have been on the decline. What this has led is, this has led to stockpiles building in Iran. Another reason for building stockpiles over here could be, in recent months we had like the Iranian production increasing slightly in anticipation of that the sanctions would be lifted, which unfortunately did not materialize. But that shows, like, our data coverage, especially on onshore crude inventories and movement of Iranian crude condensate exports. Another interesting thing, like I talked about in the previous slide, these vessels. So right now, as of July 18th, we are tracking around 11 unique tankers, most of them Aframaxes. They were previously carrying Indian crude oil, but they have now shifted to carrying Russian cargoes, Russian crude oil. So that's an interesting trend. Like, these ships and similar activity, dark STSs, and yeah, that's pretty much on. I think David would like to add something Venezuela over here as well.
Yeah, no, I just wanted to mention very quickly that there is an interesting type of dark market now opening up that's becoming pretty big. So it's not only Iran and Venezuela, it's also Russia. Especially in China, we see the direct competition of those barrels for limited market space, because actually most Chinese buyers are cautious about this type of sanctions, or actually sanctioned barrels. And I just wanted to quickly point out that we have just published on our website a nice deep analysis on all these flows, especially on the Iranian flows, but also the repercussions this is having on the market. And some knock-on effects are also hitting other players like Iraq, for example, that is struggling now a little bit more to place its barrels, especially in the Asian market. So now I think we have Pamela coming in and telling us a little bit about the clean product market.
Hi, yes. So as we've seen recently, we've seen global gasoline exports and liftings hit sort of data set highs. We've seen large volumes of diesel as well getting exported. But what we're starting to see now is, and this chart highlights it nicely, both on the left and the right. So on the left side, we have clean product imports to Latin America, which is excluding Mexico. And because Mexico is such a pillar of strength, especially for gasoline imports, we decided to exclude it. And you can see this downward sort of trend since the end of last year, December of last year. You can really see that starting to fall, and I think that really supports just the the high prices that we've seen, especially for the gasoline markets, and you can see that representative in the gasoline crack, which continued to fall further. You also see over here on the east of Suez side, you see this major consumer region in Southeast Asia, excluding Singapore and Malaysia. Singapore and Malaysia act as more of a storage hub. So you actually see kind of imports growing there. It's kind of like the ARA equivalent, I suppose, of Europe. But you can really start to see the downward trend here, as well as high prices and lack of subsidies are really eating into consumer demand. I think the biggest portion here is, it looks like drop month on month is Indonesia, which is a major gasoline importing country.
Yeah, and then let's have a look at China. I think a pretty impressive chart we have here on the left-hand side. This is China's seaborne imports of oil and gas put together on a barrel by barrel basis, a little bit unusual for gas, of course, but nevertheless, it gives you a pretty impressive picture on the overall path. So in fact, we do have in June and also first 20 days of July, a 4-year low in imports of all these products. And you can also see how low crude imports have been over the last 2 months. And LNG imports are also declining, but also clean product imports are declining. Now, this chart, I would say, is raising pretty big question marks about the health of the Chinese economy. And one question we've received was about when or whether crude imports into China will pick up and what that does to the market. For the latter question, Johannes will answer this towards the end of the presentation. But for the general comment, I think there is a lot of question marks whether this weakness in Chinese oil demand, gas demand, but also basically the weak GDP development, whether that is exclusively due to the COVID restrictions. And I think this is definitely not the case. There is a biggest, more structural problems going on in the Chinese economy. Joanna will point out in a moment the weakness in the NAFTA market, which is also hinting at weakness in the economy, Southeast Asian market we've seen before. So there are big structural issues. Essentially, we are, I think, pretty clearly heading into a global recession. It may be type of already there in the Asian market. So that's what we're seeing. And it's important basically to keep in mind, on the other hand, if you want to take a bullish note on this, that the market is as tight as it is, and we have seen stock draws in global crude over the last 2 months or so, even though the Chinese demand and other demand aspects are so weak as they are right now. A couple of quick comments also on the LNG market. We see here European LNG imports. They are now seasonally coming down. Of course, you may well know that Europe should be inclined to take as much LNG as they can, but there are also some limitations on the infrastructure connections between European countries. Demand evidently now over the summer months is significantly lower than in the winter months. US imports have come down. Partly this is already the impact of the Freeport outage, which is quite significant, taking about 1 million tons a month out of European imports. This is also basically a little bit illustrating how difficult it will be to replace the Russian gas. It looks like that the Nord Stream 1 pipeline has restarted operations today, so it's not yet off, but I think most European market players expect it to be turned off at some point of time, depending on the political will of President Putin. The things I wanted to put into perspective, about 70% of US LNG has gone to Europe so far this year. That makes about 40 to 50% of the European imports already. And the LNG side makes up only about 20% of the standard European gas imports. So the US alone, even though there's definitely hopes from the European side for more LNG, especially when Freeport is coming back, but the US alone will be far too little to help out the European market, and that will have big knock-on effects. I'm coming back at a later point towards the end of the presentation again. Joanna, please.
Yeah, so current naphtha cracks are weak, and so is demand for it in the petchem feedstock market. But here we're showing kind of an increase in supplies from the Pacific Basin, even though it is similar to what we saw earlier in the first half of the second half of 2021. The drivers are different. So in 2021, naphtha cracks were very strong, coupled with strong supply of, from the east of the Suez, but it wasn't, sufficient because the supply from the Atlantic Basin was so small. Versus on the second half, even though supplies from the Atlantic Basin continues to fall, we're not really and it didn't really help naphtha, right? Even, and it wasn't able to keep up with transportation fuels there. So, which will have a further impact on the light distillate and a knock-on effect on the gasoline. Furthermore, the refining sector has struggled to supply enough transportation fuel, but we can see here in that South Korea is increasing their refinery runs, and so in the first half of July, so likely to be a year-to-date high. However, the refining margins have fallen, and with weak ethylene cracker margins, refiners are likely to pull back.
Yes, so perhaps to add, we had basically so far this year, we had a long period of time where petchem margins were already pretty weak in petchem components, but we had 3 months or 4 months in the recent past where product cracks, transportation fuel cracks were strong. So the gasoline strength to a certain extent could easily counterbalance the weakness of naphtha. The US was, for example, or various markets were optimizing the naphtha use in the gasoline pool, attracting high amounts of high octane components. But this column of strength is now also breaking away a little bit. Asian gasoline cracks have been at least temporarily below $10 per barrel recently, so a complete collapse there. So that means that the strength in the refining industry is now fully focused on the diesel market. And that is happening even though, diesel supplies are not that bad, but we come to that back to that in a moment. Before, a few more comments on gasoline.
So yes, before we get to the star of the show, which is diesel, a little bit more on the recent fall. So as I mentioned before, gasoline exports, we're seeing again a data set high for July. The European gasoline exports have also been increasing. Europe has maximized refinery runs to make diesel, as the refineries do, with gasoline being a byproduct. So you can see that increase month on month of gasoline exports. What's beginning to change since Europe has this year, well, since about April, when the ARB finally opened, I think it was the end of April, the ARB finally opened towards Pad 1, you can now start to see Europe sending a larger percentage of its share of gasoline to the West African markets. And this is largely because Pad 1, or the US in general, has had some disappointing gasoline demand figures. Pad 1 stocks are, although below the 5-year range, are starting to build, and you know, kind of over that that peak driving season, which tends to be around the 4th of July. So all things look a little bit poor here for the gasoline market, but we will expect refineries to switch their yields as much as they possibly can, especially in the US, towards making diesel. Now, just a quick comment here on this chart on the right is showing floating storage. So these are floating storage vessels laden with diesel and gasoline off the coast of Mexico, and they are primarily off the coast of West Coast Mexico. But you'll notice that in mid-June here, where we reached the peak, it's only 8% difference than the peak of floating storage, which was, of course, during the height of the pandemic here. It was actually in May of 2020, so it's only an 8% difference. You know, those inventories building off the coast of West Coast, well, they're falling in the last couple of days, but that floating storage could be an indication of you know, subsidies or tax credits being slashed in Mexico, and looking to place barrels at the best price in the various storage locations around Mexico. Can you go back one? You missed 13. That's all right. Just now turning our heads to the diesel market, which is most likely going to be the most exciting market for the medium to long term. And this is really the reason why we have seen global diesel liftings set a record high here in July, and you definitely can see higher volumes coming out of the European region, and also the Middle East, and the US. Proportionately, the US is smaller volumes, but certainly it has increased diesel cargoes, especially headed towards Europe. And what's interesting also is you see on the European diesel import side, you see that relatively speaking, you've had, you know, relatively high volumes of diesel coming into Europe. You see more and more that Middle East, that light blue share increasing, and we would expect that to continue to rise, especially since all these volumes here in the red line, which are coming in from Russia and have been steady high volumes coming into Europe, will need to be replaced. I think the deadline is the beginning of February of 5th of February 2023. Obviously, you know, most buyers will be looking before that to replace these barrels coming in to Europe. We do expect European refineries to make up a large portion of that as they continue running hard. But of course, let's not forget that we do have the autumnal maintenance season that will be coming up in September, October, November time period. This will.
Yeah, I think you wanted to say that you expect the US refiners to meet a big share.
Yeah, that's
yes.
correct. So what we'll be looking to turn to is, although the US refining system is, as we know, built to make gasoline, and the gasoline is really the star of the show there, most likely the refineries there will want and be incentivized to flex its yields to make as much diesel as possible and take advantage of those economic incentives. So just a little bit more on the increase in Middle Eastern exports. Here we have the Saudi Arabia clean exports by product group, and you can see this increase here in yellow of diesel gas oil. So I think that's really the key message here is that the Middle East will look to produce more, and obviously will provide those alternative supplies for Europe as Russian barrels get backed out. Also, we have Kuwait, which has increased a large share of its diesel exports here as well, as you can see in the red line above all clean products.
Yeah, Kuwait has long worked on a clean fuels project, and it looks like that they have finally managed to get it into production, because this increase in output, it's really a big jump, right, in scale. So some 100,000 barrels per day additional. A couple of other countries as well that are adding supplies, like the UAE. But overall, the question is whether there is more capacity available at this point of time, unless the new refining capacities in Kuwait, Al Sur, in Qatar, Al Duqm, and also Jazan in Saudi Arabia are finally starting. That can make a difference, but the existing system is probably already pretty much maxed out at this point of time.
Yeah, and so also just taking a look at India, because globally India has the world has I think gotten used to a large volume of Indian exports on the clean product side, but what actually the Indian government has recently imposed regulations to where exporters can sell a limited volume of their gasoline and diesel to the export market, and they're incentivizing the exporters to sell those volumes instead to the domestic market to meet high domestic demand. So what this means is less overall volumes of diesel and probably gasoline blending components, which is having an impact now because we've seen such high prices for these blending components. Especially for the high octane blending components that move into PAD 1. We're kind of moving into winter gasoline season, so that will have less of an impact to the gasoline market, but certainly that the lower volumes of diesel will certainly help support the diesel crack going forward. Thank you.
Perfect. Let's go now onto the CPP tanker market, and for this slide we will actually focus on the Western Hemisphere. So what we've seen is that for the west of Suez, MR rates for both gasoline and diesel dominated routes have not only plateaued, but they're also following a downward trajectory from May and June's level. And as a result, owners' earnings have dropped, especially like the MR Atlantic basket has dropped by 40% from the annual highs that were reached 2 to 3 months ago. And as we can see from the first chart on the demand side, this is mostly because ton miles for gasoline cargoes, which you can see from the yellow line, have actually stabilized at a lower level from June onwards, signaling the end of the seasonal gasoline demand. We have also started seeing lower gasoline transatlantic flows towards the US, as well as slight inventory builds. Now the reverse is observed for diesel cargoes, which are going from strength to strength. And this is primarily due to the robust diesel exports towards Mexico. So this demand is mostly focusing on the America side. However, this rise in demand has actually caused a persistent high tonnage availability around the US Gulf, and it's currently limiting any upside towards TC14, which is the US Gulf to Europe routes, as well as the US Gulf to Latin America route, which is the TC18. Now, looking forward about this market, we're expecting that MR rates in the Atlantic Basin will probably not reach the high levels that we're seeing in May and June. However, they could hover around similar levels to today's or at least at higher levels when compared to the last quarters of the previous years. And although, as we said, like we expect this drop on transatlantic gasoline flows, nevertheless, product inventories, which are still limited, could trigger higher flows than what we've seen like the previous year, slightly supporting TC2 rates. But of course, as Pam said earlier, the strength is probably going to come from diesel. Diesel inventories are also low, and although we might see a softening of demand from the whole Latin region, which is mostly sideways currently, with winter seasonal demand in the Northern Hemisphere and Europe will support diesel flows out of the US Gulf, with Europe also, as also Pam said earlier, try to replace lost Russian supply. And as mentioned beforehand, there is this oversupply that is plaguing the Americas, and this has commenced the trend of MRs repositioning from the west of Suez to the east of Suez, as you can see from the right hand side chart. And this could then further tighten the supply in the Western Hemisphere and lead to a stabilization in rates going forward for the second half of the year. Of course, this extent of migration will be also reliant to the rates of Chinese clean exports and how much of the tonnage they could actually absorb, how much of this MR tonnage. But looking a bit further as well, for the remainder of the year, in terms of deliveries, we're expecting slightly less MR deliveries than the first half of the year, which is supporting for the rates. However, at the same time, we're also expecting scrapping activity to remain scarce because of the profitable clean environment for owners, as we can see from this slide, and taking actually a bit of a bigger picture stance and synopsize the main points that like have been covered in this webinar. From a freight lens, we can see that freight rates indicate these healthy levels with what we have seen since 2019, and this also reflects a strong increase in the global crude and refined product liftings in the third quarter, as David said earlier. However, there are some fundamentals which show that another story unfolds, and this story actually could bring some clouds over the future development of the freight rates on both the crude and the clean tanker. So taking it separately, on the clean side, the previous quarter we saw a stellar increase of clean rates, and the foundation of the stellar increase were MRs, especially on the back of the transatlantic flows, but that, as we explained, is not followed through in the third quarter. We've seen that the global refinery system is reaching its peaks. We have seen Southeast Asian demand that appears to be down based on the latest import levels. And as we said, weakening transatlantic gasoline flows towards Part 1. The Central and South America clean imports are also flat. And however, the silver lining for the clean market seems to be the resurgence of the LR2 demand, which is backed by the increased diesel exports out of the Persian Gulf, as Pam also showed earlier. And this is a trend that we will likely continue to see at a greater extent as Europe's severance from Russian diesel will give birth to long-haul voyages. So like Europe will source more cargoes from the Middle East, possibly India at an extent, while Russia will probably export more towards Latin America. We've seen this in the case of Brazil and West Africa. And this demand for long-haul trades will actually further support the demand for LRs. Hence, we're expecting them to take the spotlight from MRs going forward. Finally, on the dirty side, this post-Russian invasion shuffling of flows has had Aframax as a winner, with ton mileage increasing considerably as more Russian crude barrels are heading towards Asia. However, when talking about the workhorse of the crude trades, the VLCCs, despite the rise of global liftings, ton mileage remains really low, and this is because VLCCs are still supported from barrels out of the US Gulf, but the majority of them are heading towards Europe and partially towards the east. Now, it remains to be seen if the recent increase in Saudi and UAE exports will be maintained and will support further the recent rise in VLCC rates. Another question that needs to be answered is whether Russia barrels could be the savior of VLCC rates going forward, and likely the answer is no. As Rohit showed earlier, like around 2 million barrels of Urals are heading towards European destinations, but it's not definitely sure that Russia will be able to maintain these exports post 2023, as its relationship with Europe continues to remain sour. And at the same time, it also depends on what types of vessels are willing actually to carry this Russian crude. And as we saw recently, this is happening mostly on through dark STSs with vessels that are actually involved in sanction trades. And furthermore, we could see also Russian-owned or affiliated vessels involved in these trades. And like these type of vessels are not the conventional VLCC fleet, thus will not provide a boost on rates. So finally, the most likely candidate to be a savior of VLCCs could potentially be China, if the country, as someone asked this question earlier on, decides to finally ramp up their imports, which still remains at low levels. This could significantly boost ton miles, especially if barrels continue to come from the US. But as David said earlier, we have signals that for now this seems improbable. Thank you. Back to you, David.
Thank you. Joanna will come in for LPG slide.
Yeah, so on monthly global LPG exports, they've continued to grow above the last 3 years. Thus far, global exports have grown about 5% in the first half of the year compared to the same period last year. North America accounts for about 45% of all LPG exports, while the Middle East accounts for 30%. For July, thus far, exports from the US are not as robust as June, as the petchem margins in Asia are unfavorable, limiting not pulling that extra barrel, while exports from the Middle East have remained steady. While we look at the importing side or the demand, the top 5 countries in Asia and globally have remained in the same spot, and have not really seen a large growth in their imports this year. It's about 12% so far. Where South Korea and Indonesia are displaying a higher growth rate than China and India, and that's because China and India have experienced increased refinery runs, so they're producing a little bit more LPG locally, and they're keeping that, for their local demand, therefore just not requiring as many imports. And then the big highlight here would be imports into Europe have grown significantly. It's been 10%, in the first half of the year, and I think this will continue, as the conflict in the Ukraine continues. It'll kind of pull more barrels of LPG to satisfy their need there. Okay,
good. So I will try to sum up things a little bit and bring some final perspectives, especially on the how the whole situation with Russia will go on. As indicated before, Europeans are bracing themselves for living largely without Russian gas supply, and that is a huge challenge for the market that is highly dependent on the fuel. What is happening already in quite a number of countries in Europe is that power plants or industrial operations are switching from natural gas to diesel and to other oils. European refiners are probably switching away from natural gas as a refining fuel to LPG, for example. Even naphtha burning could be something that could become interesting again going forward. India has a history, for example, of burning naphtha for power generation. So just to put things into context, of course, the gas shortage in Europe is tremendous. But if you put European gas demand in relation to world oil demand, world oil supply, you can actually see that Europe accounts for less than 10% as a share. And what I want to say with that, if we assume basically that Europe cuts some of its consumption and continues to get about a third of the supply via other sources, then we are maybe talking about something like 5% of world oil demand that is needed, so to say, to replace for the power shortage, for the energy shortage in the European market. So ultimately, what I do want to say with it is the natural gas situation in itself is potentially really pretty unsolvable for Europe, but there are ways around it, and oil may play a surprisingly big role of that as we move forward. And most of that is likely to materialize on the side of diesel. So that's basically making also our key message here. Diesel is the product to look at. We have it's clearly the strongest product now from a crack perspective, and this is happening even though the Europeans have so far failed entirely to replace Russian oil on the or Russian diesel. So in actual fact, the July readings so far point to a 30% higher intake of Russian diesel than what is usually the case. Residues have already been replaced by more than 50%, about 40% of the crude has been replaced, but other clean products and especially diesel have not been replaced at all. And as pointed out, this is really, really a big volume, so that all this diesel strength that we have seen occurring over recent months has been happening even though Russia has continued full supplies to the European market, and Europe has not really looked out for significant additional volumes to other markets. But this is going to change going forward, as the replacement is necessary, but also as demand is likely to receive a boost from the lack of power and of energy. Of course, the droughts and all the other issues. Nuclear power is a huge, huge problem in France, specifically power prices for the next year about twice as high in France than in Germany. So this is just to implement that there is actually even bigger problem in France with nuclear power than Germany supposedly has with Russian gas. So we are moving here into a very difficult environment. So Europe will attract as much LNG as it can. That will make this very expensive for other countries. We are seeing the political problems in Sri Lanka. Pakistan is a big concern that this type of uproar may move in there. So also other countries will look for cheaper alternatives to LNG. And oil is likely to play a role there. And for the refining side, this simply means that as said, naphtha has already been very weak. Gasoline has now joined this, and from a seasonal perspective, there may be a little bit of upside from Asia towards the end of the year. But otherwise, it's now really looking like the diesel will be the dominant product for 6 to 12 months to come. And therefore, it will be very interesting to see how much the global refining system, and in particular the US refining system, can stretch yields from gasoline towards diesel. That is what we would expect to happen, and that will lead to a big flow there, of course, as well, to the European market. Yeah, and for the overall outlook, the demand, of course, is much weaker already now, so we can see this. Oil supply, in terms of crude oil supply, is not really particularly tight, so there is some reason basically to the lower oil prices we have seen over recent weeks. But what should be taken into consideration, two of the slides we have shown, one is Chinese crude imports have really been extremely low and are likely to grow going forward from this very low level, and they may grow significantly if there is really an economic recovery, where it would be a little bit doubtful. And the other thing is Russia has exported higher volumes rather than lower volumes of crude so far, and whether that will go on going forward is questionable. There is, of course, this idea of the price cap that is evidently discussed pretty seriously, but it's also there is very well the possibility that Russia will on its own curtail crude exports, if at least temporary, in such a situation. And even if not, all the sanctions that are placed on the shipping industry and so on, they are getting more strict, and there appears to be a relative strong global adherence to this idea that Russian crude is not a suitable feedstock. So far, we're essentially only seeing India and China buying the Russian oil on top, a little bit of fuel oil in the Middle East, but otherwise there are not really any countries stepping in, and even China is very cautious in this regard. So from the marginal point of view, there are good chances that the crude side can strengthen again and will not be as loose as we have seen over the recent past. As said, it's questionable whether Saudi Arabia and the UAE can really increase production dramatically on a consistent basis. And on the product side, yeah, we have this very strong favorable conditions for diesel that will test the global refining system to an unseen extent. Yeah, many thanks for your time. A long resume at the very end. I hope you enjoyed the presentation. Yeah, we would like to see you again in future briefings and meetings and webinars. Looking forward to that. Many thanks.